Let me be very direct with you right from the start. What is happening in this market right now is not random noise. It is not just another volatile day. Today, three completely separate signals, a geopolitical shock, an institutional buying surge, and a historical monthly pattern that has only appeared once before in Bitcoin's entire history, are all aligning at the exact same time. And the people who understand what that combination means are quietly positioning. The people who don't understand it are either panic selling or frozen, waiting for someone on the internet to tell them what to do. I'm not here to tell you what to do. I want to be clear about that up front. Nothing in this video is financial advice. I'm an analyst. I read data. I explain structure. Every decision you make with your money is yours, and it should be based on your own research, your own risk tolerance, and your own timeline. What I will do is give you the most complete, honest picture of what is happening right now so that whatever decision you make it with information and not with emotion. Let's start with what just happened, because the timeline matters. Overnight, news confirmed that Iran struck a major Saudi Aramco oil refinery. Now, if you've been in markets for any period of time, you know what that kind of headline does. Energy infrastructure in the Middle East is one of the most sensitive global economic triggers that exists. The moment that news hit, markets reacted immediately and decisively. Oil prices spiked, initially as much as 7%, now sitting around 4% higher. Natural gas is up 1.5%. The entire energy sector is elevated. Gold, the world's oldest safe haven asset, crossed $5,400 per ounce. That single move added roughly $1 trillion in market cap to gold in just a matter of hours. Silver followed, crossing $96, up over 4%. These are the assets that traditionally absorb fear capital in times of geopolitical escalation. And today they are behaving exactly according to that script. Meanwhile, equity markets took the hit. S&P 500 futures dropped 1.4%. Nasdaq was in the red. The classic risk-off rotation happened at textbook speed. When geopolitical fear spikes, the playbook is the same every time. Sell equities, buy gold, buy oil, buy treasuries, wait and see. And Bitcoin. Bitcoin dropped from around $67,400 down to $65,600 in the hours after the news, a $1,800 swing. That sounds dramatic. But here's the thing you need to understand, and this is the first critical point today. Before this, Iran news even broke, Bitcoin had already sold off from $68,000 all the way down to $63,000 when the initial attack was first announced over the weekend, and then it bounced, all the way back to $68,000 on its own. Without any macro tailwind, the market absorbed that shock, recovered nearly $5,000, and now with a second wave of Iran-related headlines, it's only sitting at $66,900. It did not break the weekend low of $63,030, not even close. That is strength, not weakness. In a market that is supposed to be fragile, in an environment where every other risk asset is getting hit, Bitcoin held a significant support level through two geopolitical shock events in a row. That is data. And data matters more than feelings. Now let's talk about the situation going forward because this is not something that resolves overnight. President Trump's statements confirmed that the situation in the Middle East could continue for up to 4 weeks. That is the official timeline being communicated, which means short-term pressure on risk assets could persist, which means we are not in a one bad day and then everything recovers environment. We are in a sustained pressure environment. And in sustained pressure environments, how assets behave at support tells you everything about what comes next. I also want to say something that most analysts don't say. But that needs to be said honestly. If this situation escalates dramatically beyond what we are currently seeing, the conversation changes entirely. If we are talking about full-scale regional conflict, global supply chain disruptions of a severity we haven't seen in decades, at that point, how many Bitcoin you hold is genuinely not your top concern. Your concern becomes family, safety, stability. I say this not to be alarmist, but because honesty demands it. The scenario we are analyzing is the more probable one, elevated tension, sustained pressure, but not total global escalation. In that scenario, which is the scenario the data supports right now, Bitcoin's behavior becomes very interesting to analyze. Stop for a moment and think about something. While you were watching the Iran headlines this morning, while retail Twitter was debating whether to sell everything, while fear was dominating the sentiment data, what were institutional investors doing? United States spot Bitcoin ETFs, the ones managed by BlackRock, by Fidelity, by the largest asset managers on the planet, recorded more than $1 billion in net inflows over 3 consecutive days. They broke a 5-week outflow streak. They are buying. Right now, in this environment. With Iran headlines dominating the news cycle, with gold at $5,400, with equity markets red, they are actively accumulating Bitcoin through regulated institutional-grade investment vehicles. Let that sink in for a second, because this is not a small signal. Institutional money doesn't move emotionally. It doesn't see a scary headline and panic. Institutional money looks at structure, it looks at valuation, it looks at leverage conditions in the market, it looks at historical analogs, and it makes calculated, deliberate moves. The fact that $1 billion is flowing into Bitcoin ETFs during a geopolitical risk-off event is telling you something specific. Sophisticated, large-scale investors believe this is an accumulation opportunity, not a reason to exit. Now let's talk about why they might believe that. Because the market structure data backs it up completely. Open interest on Binance, one of the clearest measures of leverage in the crypto derivatives market, has dropped 25% since the start of this year. It fell from 130,800 Bitcoin to 97,680 Bitcoin. The estimated leverage ratio is sitting at 0.146. That is the lowest it has been since the April 2025 correction. What does that mean in plain language? It means the system has been cleaned out. The over-leveraged longs that got burned in the last few months, gone. The reckless speculation that characterized the peak period, flushed. What you have left is a market where leverage is minimal, where the remaining holders are either long-term believers or institutional positions, and where, if a positive catalyst comes, there is very little overhead leverage to slow down a move to the upside. Think of it like a room that's been cleared of furniture. Right now, the room looks empty and boring, but when the right catalyst comes, you can move fast in an empty room. In a room full of furniture, full of over-leveraged positions, full of weak hands, every move is slow, every spike gets sold, every squeeze gets absorbed. Right now, the room is empty, and that is structurally important. There is also this. Bitcoin's funding rates, the fee that leveraged long traders pay to short traders or vice versa, are near neutral to slightly negative in some windows. Slightly negative funding means shorts are paying longs in certain time frames, which means there are shorts in this market who are betting on further downside, and those shorts represent fuel. If price moves up, those shorts need to cover, and covering shorts means buying, and buying means price goes higher, faster. It is a mechanical reality of how derivatives markets work. The short squeeze potential, when leverage is this low overall but short interest is elevated in specific windows, is significant. This is not speculation. This is how the math works. Now let me walk you through the 3 scenarios that matter for the next 48 hours, because this is where most people lose money. They don't plan ahead for multiple outcomes, so when one of them happens, they react emotionally instead of executing a plan they already thought through. Scenario 1. Iran situation stabilizes. No further escalation over the next 24 to 48 hours. Oil prices start to cool. Gold's initial spike fades as fear premium gets priced in and then starts to unwind. Risk appetite slowly returns to equity markets. In this scenario, Bitcoin needs to reclaim $67,000 with meaningful volume during the US session. If that happens, if you see Bitcoin push above $67,000 on above average volume this afternoon, the bear flag structure invalidates. From there, $68,500 to $69,000 becomes the first target. That's the upper range where the Bollinger Bands and short-term moving averages converge. If momentum carries through that level with institutional buying continuing, $70,000 to $72,000 is the next significant resistance cluster. That zone has historically been a high-volume area where selling pressure reemerges, but getting there would represent a meaningful recovery from today's lows. Scenario 2. Iran's situation deteriorates. More strikes, more escalation, more oil supply disruption fears. Global equity markets extend losses. Safe haven flows into gold continue. Risk assets stay under pressure. In this scenario, Bitcoin's $65,000 to $65,600 support zone becomes the defining battleground. If price breaks cleanly below $65,000, and I mean a clean close below it on the hourly chart with volume, then $63,000 comes back into play. That's the weekend low that has already been tested once. A retest of a level that has already been touched is often resolved more violently than the first touch because more traders have their stop losses clustered there. Below $63,000, the next meaningful support is around $60,000, a major psychological level. And below that, the 200-week moving average sits around $58,000. For long-term investors, that level has historically been one of the most reliable accumulation zones in Bitcoin's entire history. It's not a comfortable place to buy when you get there because when you get to the 200-week MA, the fear is usually at its absolute maximum. But the data on what happens after buys at the 200-week MA is hard to argue with. Scenario 3, and pay very close attention here because this is the one that will catch most people completely off guard. Gold's fear spike starts to fade. Geopolitical premium gets absorbed. Institutional money that panic rotated into gold starts looking for the next move. And here is the historical reality. The Bitcoin to gold ratio has been at historically compressed levels. Analysts who track this ratio argue that Bitcoin is anywhere from 24% to over 60% undervalued relative to gold based on the long-term ratio. If even a fraction of the capital that rushed into gold in the last 24 hours starts rotating, and remember, gold's total market cap is much larger than Bitcoin's, so even a small percentage rotation means enormous dollar flows into BTC, combined with the $1 billion in ETF inflows already confirmed, combined with leverage being at its lowest since April 2025, you get the conditions for a short squeeze to the upside that is violent, fast, and completely unexpected by the majority of participants who are positioned bearish right now. This is not a prediction. This is a scenario. But it is a scenario that the data supports as possible. And possible scenarios that most people aren't thinking about are exactly where the biggest opportunities hide. Now let me give you the bigger picture, because what is happening right now does not exist in a vacuum. It is part of a larger economic story that has been playing out for decades. and that Bitcoin was specifically designed to address. Every major crisis in modern history has been resolved the same way. Not with discipline, not with structural reform, with money printing. In 2008, when the global financial system was on the verge of collapse, the United States injected $3.5 trillion into the system. Banks were saved. Markets eventually recovered. But the money supply expanded dramatically. In 2020, when COVID shut down the global economy, the response was $5.5 trillion in stimulus and quantitative easing, the largest peacetime monetary expansion in human history. Markets crashed and then went to all-time highs. Assets went to the moon. Real estate, equities, crypto, everything that is scarce and real went up because the dollar that was used to price it went down in purchasing power. Now look at where we are. Iran situation escalating, oil prices spiking, global economic pressure building, supply chains being disrupted, energy costs rising, and a U.S. government that has one proven tool in its crisis playbook: print money and inject it into the system. If that happens, and based on every historical precedent, that is the most likely policy response to a sustained geopolitical economic shock, then risk assets benefit. And Bitcoin, with its fixed supply of 21 million coins, no government controlling its issuance, no central bank that can dilute it, Bitcoin benefits specifically and structurally from money printing in a way that even gold does not, because gold supply can be expanded with enough capital investment in mining. This is not a hopeful narrative. This is a thesis based on observed government behavior over multiple decades. The only thing that has ever changed between each crisis is the scale. 2008 was 3.5 trillion, 2020 was 5.5 trillion. The next intervention will likely be larger. That capital has to go somewhere. Fixed supply assets are where it goes. Here is also something specific to today's news that deserves attention. Morgan Stanley has applied for a bank charter specifically to custody crypto assets. Think about what that means in practical terms. Morgan Stanley has approximately 15,000 financial advisors serving some of the wealthiest clients in the United States. Until now, those advisors had limited ability to offer crypto exposure through Morgan Stanley's own banking infrastructure. A bank charter changes that. It means Morgan Stanley clients, high net worth individuals, family offices, institutional accounts, can hold crypto assets custodied directly through Morgan Stanley. This is not a small event. This is the continued methodical institutional integration of Bitcoin into the traditional financial system. And it is happening right now, in the middle of geopolitical uncertainty, which tells you that the institutions building this infrastructure are not doing it for short-term price action. They are building for a future where Bitcoin is a standard allocation in serious portfolios. Now let's talk about the monthly chart, because this is where the most powerful signal in today's analysis lives, and most people completely overlook it. Bitcoin closed February in the red. That means we now have 5 consecutive down months: October, November, December, January, February. 5 months in a row of declining closes. If March closes red, that will be 6 consecutive down months. And here's what you need to understand about that number. In Bitcoin's entire history, 6 consecutive down months have occurred exactly once before. In 2018 going into 2019, and what happened after that 6-month down period, Bitcoin went on one of the most explosive rallies in its history, moving from roughly $3,500 to over $13,000 in a matter of months. The people who held through those 6 brutal down months, the people who ignored the Bitcoin is dead narratives that were everywhere in 2018, those people experienced one of the greatest returns in financial history. 3 consecutive down months in Bitcoin's history have almost always been followed by at least some form of reversal. 4 down months in 2014 was followed by a 13% gain the next month. The brutal summer of 2021, 3 consecutive down months, was followed by a historic Q4 that took Bitcoin to its then all-time high. The pattern is consistent. Is it a guarantee? Absolutely not. Past performance is not a promise. Iran could get worse. Macro conditions could deteriorate. Black swan events by definition are not predictable. But rational analysis of probability says, at 5 consecutive down months, with institutional buying confirmed, with leverage flushed out of the system, with sentiment at extreme fear, the historical odds favor the patient, long-term holder over the person who exits now. The fear-greed index is currently reading extreme fear. And I want to tell you something specific about extreme fear readings. Every single time in Bitcoin's history that the fear-greed index has been in extreme fear, every single time, it has eventually proven to be a better than average time to accumulate for people with a time horizon longer than 90 days. The worst case historically has been you wait about a year to get to break even, and then you go higher. That's the historical worst case. The best case is you buy at a generational low, and you look back in 5 years and you understand exactly what today was. Now here's where most retail investors make their critical mistake in a moment exactly like this one. They look at the price, they see it going down, they feel the fear, and they either sell, locking in losses at the worst possible moment, or they freeze and do nothing, which in a market like this means they miss the accumulation window that institutions are quietly taking advantage of right now. The third mistake is using leverage in this environment without understanding that when leverage ratio is at 0.146, any move in either direction, up or down, can be faster and more violent than you expect. Leverage in a low OI environment is like standing on ice. You can move very fast. You can also fall very hard. If you are using leverage, position sizing is everything right now. This is not a stable, range-bound environment where leverage is forgiving. What the data is saying, and I want to be clear, this is data interpretation, not financial advice, is that the structure of this market right now looks like the setup that precedes a major move. Not necessarily tomorrow, not necessarily this week, but the conditions that historically precede significant upward movement in Bitcoin are leverage cleaned out, check. Institutional buying confirmed, check. Extreme fear sentiment, check. Extended consecutive down months pattern, check. Macro catalyst that historically triggers money printing, check. When you have 5 of 5 boxes checked simultaneously, that is not random. That is a setup. Here's how I think about the levels you need to watch for the rest of this week. On the downside, $65,000 is the first line. If that breaks, $63,000 is the next test. Below $63,000, $60,000 becomes critical. And if $60,000 fails, the 200-week moving average around $58,000 is where the most historically significant support lives. On the upside, reclaiming $67,000 with volume is the first signal that the pressure is easing. Above that, $68,500 to $69,000 is where short-term resistance sits. A clean break through $69,000 opens the door to $72,000. And a sustained move above $72,000 changes the entire medium-term structure of this market. The next 48 hours will likely determine which of these paths is most probable. Watch the Iran headlines. Watch oil prices. If oil starts cooling, risk appetite returns fast. Watch the ETF flow data. If institutional inflows continue at this rate, that is a sustained accumulation signal that has historically been bullish on a 30 to 60-day time frame. Watch the $65,000 level. That is your fulcrum. Above it, the setup is constructive. Below it, patience is required at lower levels. I want to close with this. The people who have made generational wealth in Bitcoin have never been the people who timed every move perfectly. They have been the people who understood the thesis deeply enough that when moments of maximum fear arrived, and they always arrive, they did not let that fear override their analysis. They held, they accumulated, and they waited. Because Bitcoin has a track record now. It has survived multiple "this is the end" moments. It survived 2018. It survived March 2020 when it crashed to $3,800 in a single day during COVID panic. It survived the FTX collapse. It survived every single time someone said it was finished. And it came back stronger each time. Because the fundamental thesis, fixed supply in a world of infinite money printing, has not changed. It has only gotten stronger as more institutions have validated it. That is what today is. Another test, another fear event, another moment where the data says one thing and the emotion says another. The question is which one you listen to. Drop a comment below and tell me, are you holding through this, buying the dip, or waiting for a lower level? I genuinely want to know where you are positioned and what your thinking is. And if you want to see the full technical breakdown of the specific chart levels I'm watching on the 4-hour structure, the exact entry and invalidation zones that I use to build my own analysis, that video is right here. Go watch it. I'll see you there.